Ladies and gentlemen, in 1932, the United States government did something that would be considered unthinkable today. They knocked on doors across America and forced citizens to hand over their gold at gunpoint, paying them just $20 per ounce. 18 months later, they revalued that same gold to $35 per ounce, instantly transferring 75% of America's private wealth directly into government hands. If you think that could never happen again, you're about to discover why 2026 is setting up to be the exact same playbook, just with different assets. And if you understand what's coming in the next 18 months, you could position yourself on the right side of the greatest wealth transfer in modern history. Before we dive into what's about to unfold, smash that subscribe button right now, because this channel is dedicated to helping you navigate the economic chaos that mainstream media refuses to acknowledge. We break down complex financial patterns into actionable strategies that could protect your wealth and potentially change your family's financial future forever. The information you're about to hear isn't being discussed on CNBC, and there's a reason for that. Hit subscribe, turn on notifications, and let's expose what's really happening. The fourth turning theory, developed by historians William Strauss and Neil Howe, identifies a recurring cycle in American history that repeats approximately every 80 to 90 years. This isn't some conspiracy theory or fringe academic hypothesis. This is a documented pattern that has predicted major societal upheavals with disturbing accuracy. The theory suggests that history moves in cycles called seculums, each lasting about the length of a long human life. Within each seculum, there are 4 turnings, each lasting roughly 20 to 25 years. The first turning is a high period of strong institutions and weak individualism, a time when society is confident about where it's heading. The second turning is an awakening, a time of spiritual exploration and rebellion against the established order. The third turning is an unraveling, where institutions are weak and individualism is strong, creating a period of anxiety and cultural wars. And then comes the fourth turning, the crisis period we're entering right now. Every fourth turning in American history has brought massive destruction, followed by complete reconstruction of the social, political, and economic order. The Revolutionary War seculum had its fourth turning from 1773 to 1794, completely reshaping the American colonies into an independent nation. The Civil War seculum experienced its fourth turning from 1860 to 1865, tearing the country apart and rebuilding it. And the Great Depression and World War II seculum went through its fourth turning from 1929 to 1946, fundamentally transforming America's role in the world and creating the modern financial system we know today. If the pattern holds, and so far it has held with remarkable consistency, we entered the current fourth turning around 2008 with the financial crisis, and we're now approaching the climax phase that should peak somewhere between 2025 and 2030. What makes this absolutely critical for your financial future is understanding that these aren't just historical curiosities. Each fourth turning creates specific economic conditions that destroy unprepared wealth and create generational fortunes for those who recognize the pattern. The wealth transfer during these periods isn't gradual or subtle. It's violent, swift, and it permanently alters the economic landscape. And here's what Wall Street doesn't want you to know. We're now at the exact same point in this cycle as 1932, right before the most dramatic wealth confiscation and transfer event in American history. Let's go back to 1932 and understand exactly what happened, because the parallels to today are so precise they should send chills down your spine. By 1932, the United States had been suffering through the Great Depression for 3 years. The stock market had crashed in 1929, losing nearly 90% of its value by the summer of 1932. Unemployment had skyrocketed to 25%. Banks were failing at a rate of dozens per week, and people had lost faith in the entire financial system. Citizens were hoarding gold because they didn't trust paper currency, and the Federal Reserve's credibility was in shambles. The government faced a crisis of confidence that threatened to completely collapse the monetary system. Into this chaos stepped Franklin Delano Roosevelt, who took office in March 1933 with promises of a New Deal that would save America. One of his first acts as president was issuing Executive Order 6102 on April 5, 1933, which made it illegal for American citizens to own gold coins, gold bullion, or gold certificates. Citizens were required to deliver all gold to the Federal Reserve by May 1, 1933, in exchange for paper dollars at the rate of $20.67 per ounce. The government wasn't asking politely. This was a mandatory confiscation backed by criminal penalties of up to 10 years in prison and a $10,000 fine, which would be equivalent to about $200,000 today. Americans were forced to exchange their hard money, their store of value, their protection against government monetary manipulation, for paper currency that the government could print at will. But here's where it gets truly sinister and where the real wealth transfer occurred. In January 1934, just 9 months after confiscating citizens' gold at $20 per ounce, Roosevelt signed the Gold Reserve Act, which revalued gold to $35 per ounce. Think about what just happened. The government forced citizens to sell their gold at $20, then immediately repriced that same gold at $35, representing a 75% increase. The government effectively stole 75% of the purchasing power that had been stored in Americans' gold. This wasn't taxation, this was confiscation and devaluation executed in a coordinated sequence designed to transfer private wealth into public hands to finance the massive expansion of government programs under the New Deal. The social upheaval during this period was intense. Breadlines stretched for blocks in major cities. Families lost their homes and farms when they couldn't pay mortgages or property taxes. The Dust Bowl devastated agriculture across the heartland, forcing millions to migrate in search of work. Political extremism surged, with both communist and fascist movements gaining traction among desperate Americans looking for solutions. Crime rates spiked as people struggled to survive. The social fabric of America was tearing apart, and traditional institutions, from banks to churches to local governments, lost the trust of ordinary citizens. This was the environment that enabled such dramatic government overreach as gold confiscation, because people were willing to accept almost any solution that promised stability and recovery. Now here's what's rarely discussed in history books, but is absolutely crucial for understanding what's coming. While the vast majority of Americans saw their wealth evaporated during this crisis period, a small group of people who understood the cycle and positioned themselves correctly made absolutely massive fortunes that established generational wealth. Joseph Kennedy, father of President John F. Kennedy, recognized that the stock market crash presented historic buying opportunities. He had moved to cash before the 1929 crash, then systematically bought assets at depression prices throughout the early 1930s. The Kennedy family fortune, which would eventually help finance a presidential campaign, was largely built during this crisis period by buying quality assets when everyone else was panic selling. Real estate investors who had access to capital bought properties for pennies on the dollar as foreclosures flooded the market. Industrial assets, farmland, businesses, all were available at valuations that would never be seen again. The wealth wasn't destroyed during the Great Depression. It was transferred from those who didn't understand what was happening to those who did. Fast forward to 2026, and let me show you why we're in the exact same setup, just with modern assets replacing gold. Start with the national debt crisis, which is now completely unsustainable and accelerating toward a breaking point. The United States national debt has surpassed $34 trillion and is growing by roughly $2 trillion per year. That's trillion with a T. To put this in perspective, the debt to GDP ratio has exceeded 130%, levels not seen since the aftermath of World War II. But here's the critical difference. After World War II, America was the world's undisputed manufacturing powerhouse with a young, growing population and decades of economic expansion ahead. Today, we have an aging population, declining birth rates, offshored manufacturing, and an economy increasingly dependent on financial engineering rather than productive capacity. The interest payments on this debt are now consuming over $1 trillion per year, representing one of the largest line items in the federal budget, and crowding out spending on everything else. As interest rates have risen from near zero to over 5%, the cost of servicing this debt has exploded. And here's the mathematical trap. The government can't meaningfully reduce spending without triggering a depression, because roughly 30% of GDP is now directly or indirectly dependent on government spending. They can't raise taxes enough to close the deficit without killing economic growth and making the problem worse. And they can't grow their way out of the debt because the economy is already leveraged to the maximum with corporate debt, household debt, and financial sector debt all at historic highs. There's only one way out of this trap, and it's the same solution used in 1933. Currency devaluation to inflate away the debt in real terms. The banking sector is showing stress fractures that look eerily similar to 1932, just with a modern veneer. In March 2023, we saw the collapse of Silicon Valley Bank, Signature Bank, and First Republic Bank, representing the largest banking failures since 2008. These weren't isolated incidents caused by rogue management. These were symptoms of a systemic problem. Banks across America are sitting on hundreds of billions of dollars in unrealized losses on their bond portfolios because rising interest rates have destroyed the value of the long-term treasuries and mortgage-backed securities they bought when rates were near zero. The Federal Deposit Insurance Corporation estimates that banks are holding over $500 billion in unrealized losses on securities portfolios. These losses don't show up on financial statements until the banks are forced to sell the securities, but they represent a ticking time bomb that threatens bank solvency if depositors start withdrawing funds and forcing asset sales. Just like in 1932, confidence in the banking system is eroding. Depositors are becoming aware that only about 3% of bank deposits are actually backed by reserves, with the rest lent out or invested in securities that may have declined in value. The FDIC Insurance Fund has about $125 billion to cover over $10 trillion in insured deposits, a ratio of roughly 1%. If a real banking crisis develops with multiple large bank failures happening simultaneously, the FDIC doesn't have nearly enough resources to make depositors whole without a government bailout funded by printing more currency. We're one crisis of confidence away from a bank-run scenario that could cascade through the entire financial system. Inflation dynamics are creating the same currency crisis that preceded the gold confiscation of 1933. Despite official government statistics claiming inflation has moderated to around 3 to 4%, anyone buying groceries, paying rent, or covering healthcare costs knows the real rate is much higher. The methodology used to calculate the consumer price index has been systematically altered over decades to understate actual inflation. If we calculated inflation using the same methodology employed in 1980, current inflation would be running at over 10% annually. This matters because it means the purchasing power of the dollar is being destroyed far faster than official numbers acknowledge. The Federal Reserve has painted itself into a corner with no good options. If they raise interest rates to truly combat inflation, they'll crash the economy, trigger mass unemployment, collapse the housing market, and cause the unrealized losses on bank balance sheets to crystallize into actual insolvency. If they lower rates to support the economy and help the government finance its debt, they'll unleash another wave of inflation that could spiral into hyperinflation and destroy confidence in the currency entirely. They're trying to thread a needle that may not have an opening, maintaining rates high enough to claim they're fighting inflation, but low enough to prevent economic collapse. This balancing act can't continue indefinitely, and when it breaks, the adjustment will be violent and sudden. The real estate market is flashing warning signals that look very similar to the pre-crash conditions of the early 1930s. Housing prices have become completely disconnected from income fundamentals, with the median home price now over 8 times median household income in many markets, far exceeding the affordability ratios that prevailed before the 2008 housing crash. Mortgage rates have more than doubled from the 3% range to over 7%, which has effectively frozen the housing market as existing homeowners can't afford to sell and buy another property without giving up their low interest rate, while new buyers are priced out by the combination of high prices and high rates. Commercial real estate is facing its own crisis as office buildings sit vacant due to remote work trends, retail space struggles with the shift to online shopping, and property values plummet while owners face refinancing deadlines on loans originated when interest rates were near zero. We're looking at hundreds of billions of dollars in commercial real estate loans that will need to be refinanced in the next 2 years at interest rates that make the property's cash flow negative, setting up a wave of defaults that will hit regional banks particularly hard. Stock market valuations have reached levels that historically precede major corrections or crashes. The Shiller price-to-earnings ratio, which smooths out short-term earnings fluctuations to give a more accurate long-term valuation measure, is currently above 30, a level exceeded only during the 1929 bubble, the 2000 dot-com bubble, and briefly in 2021. When valuations reach these extremes, future returns are historically very poor, and the risk of a major drawdown becomes extremely high. Corporate profits as a percentage of GDP are also at historic highs, which is mathematically unsustainable because profits are ultimately constrained by the income available to consumers and businesses to spend. When profit margins are this elevated, they tend to mean revert violently during recessions, as pricing power disappears and costs remain sticky. The margin debt and leverage in the financial system has reached extremes that amplify both the upside during bull markets and the downside during crashes. Hedge funds, family offices, and retail investors are using record amounts of borrowed money to juice returns, which works fantastically during rising markets, but creates devastating cascading liquidations when markets decline. The derivatives market, which is essentially bets on the direction of underlying assets, has ballooned to over $1 quadrillion notional value globally, creating interconnected webs of risk that regulators don't fully understand and can't effectively monitor. These derivative positions work fine when markets are stable and moving in expected directions, but they can create sudden explosions of volatility and counterparty failures when unexpected moves occur, as we saw with the collapse of long-term capital management in 1998, and more recently with the blowup of Archegos Capital in 2021. Now here's where this gets really interesting for anyone paying attention to the crypto market. Bitcoin and cryptocurrency represent the modern equivalent of gold in 1932. And I believe they're setting up to play a central role in the coming wealth transfer. Just as gold was the primary store of value outside the government-controlled banking system in 1932, Bitcoin has emerged as digital gold, a scarce asset that can't be printed by central banks and can't be easily confiscated by governments. The parallels are striking, and the implications for what might happen next should be carefully considered by anyone holding crypto. Bitcoin's adoption metrics are following a trajectory that suggests we're still in the early stages of a major paradigm shift in how people store value. There are now over 500 million Bitcoin wallets globally, though the number of actual users is lower due to people holding multiple wallets. More importantly, institutional adoption has accelerated dramatically. The approval of spot Bitcoin ETFs in January 2024 opened the floodgates for institutional investment, with funds like BlackRock's IBIT attracting tens of billions of dollars in inflows. Major corporations from MicroStrategy to Tesla have added Bitcoin to their treasury reserves. Sovereign wealth funds and nation-states are quietly accumulating Bitcoin positions, though most won't publicly acknowledge it yet. El Salvador made Bitcoin legal tender, and other nations are exploring similar moves as they lose faith in the dollar-dominated financial system. The total market capitalization of Bitcoin recently exceeded $1 trillion, and the total crypto market cap is approaching $3 trillion. These are still relatively small numbers compared to global stocks, which are valued at roughly $100 trillion, or real estate, which exceeds $300 trillion globally, or gold, which is around $15 trillion. This means crypto is still early in its adoption curve with massive room for growth, as more capital recognizes it as a legitimate asset class. The infrastructure supporting crypto has matured dramatically, with institutional-grade custody solutions, regulated exchanges, sophisticated derivatives markets, and growing payment networks that make crypto increasingly functional as both a store of value and medium of exchange. Here's what Wall Street isn't telling you about the government's view of cryptocurrency. Just as gold represented a threat to government monetary control in 1932 because citizens could opt out of the inflation tax by holding gold, Bitcoin and crypto represent the same threat today. Governments and central banks are acutely aware that if citizens move substantial wealth into decentralized cryptocurrencies, it limits the effectiveness of monetary policy and makes it harder for governments to finance deficit spending through inflation. This is why we're seeing increased regulatory pressure on crypto exchanges, proposed legislation to track and tax crypto transactions, and central banks rushing to develop central bank digital currencies that would give them the same programmable control over digital money that they have over traditional currency. The playbook from 1933 suggests that at some point during this crisis, governments may attempt to regulate, restrict, or even confiscate cryptocurrency holdings, particularly once crypto adoption reaches a level where it threatens the viability of traditional fiat currency. This doesn't mean Bitcoin will fail. In fact, Bitcoin's decentralized nature makes it far harder to confiscate than physical gold was. But it does mean that exchanges will likely face increased regulatory burden, reporting requirements will expand, and the ease of moving between crypto and fiat may be restricted. The window to position yourself in crypto while it's still relatively easy and unrestricted may be narrower than many people realize. DeFi, or decentralized finance, represents an even more revolutionary development that has no historical parallel. DeFi platforms allow people to lend, borrow, trade, and earn yield on cryptocurrency without intermediaries like banks or brokers. Total value locked in DeFi protocols has grown from essentially zero in 2019 to over $50 billion today, despite the bear market that saw values decline from over $200 billion at the peak. This is creating a parallel financial system that operates outside traditional banking, which is both tremendously empowering for individuals and tremendously threatening to the established financial order. The coming crisis will likely accelerate DeFi adoption as people lose faith in traditional banks and seek alternatives, much like people hoarded gold when they lost faith in banks in 1932. The altcoin market, while incredibly speculative and full of projects that will fail, also represents massive opportunities for those who can identify the protocols and platforms that will become infrastructure for the new financial system. Every major technological revolution creates enormous wealth for early investors who correctly identify the winners. The railroad boom, the oil industry, the auto industry, the internet revolution, each created millionaires and billionaires who got in early on companies that became dominant. Crypto and blockchain technology represent a similar paradigm shift. And while most altcoins will go to zero, the ones that survive and thrive could deliver life-changing returns to early investors. This is not investment advice, and the risk is enormous, but understanding that we're in a fourth turning crisis period where the old financial system is being reconstructed should inform how you think about positioning for the future. Government response to the developing crisis is likely to follow a similar pattern to what we saw in the 1930s, just adapted to modern circumstances and assets. Initially, there will be denial that a serious problem exists, with officials assuring the public that the economy is strong and any issues are temporary. We're still largely in this phase, with government officials and Federal Reserve members consistently downplaying inflation risks, banking sector stress, and debt sustainability issues. As the crisis deepens, there will be emergency interventions to stabilize failing institutions, similar to the bank bailouts we saw in 2008 and the emergency measures during the 2023 banking crisis. These interventions will initially be framed as limited and temporary, but they'll expand in scope and scale as the crisis worsens. Eventually, we'll likely see more dramatic policy shifts that fundamentally alter the financial system. This could include some form of debt restructuring or jubilee, particularly for government debt held by the Federal Reserve, which could simply be canceled. It could include a reset of the currency itself, potentially moving to a digital dollar that gives the government more control over how money is used and makes negative interest rates more feasible. It could include wealth taxes or forced investments in government bonds, similar to how other countries facing debt crises have required pension funds and retirement accounts to hold government debt. And yes, it could include restrictions or confiscation of assets that the government views as threats to its monetary control, which in the modern context means cryptocurrency rather than gold. Monetary policy shifts are already underway and will likely accelerate. The Federal Reserve's attempt to normalize interest rates and reduce its balance sheet after years of quantitative easing has proven unsustainable. They'll likely be forced to reverse course and return to large-scale asset purchases and ultra-low interest rates, possibly even explicit yield curve control where they target specific interest rates for government bonds regardless of market conditions. This will be framed as necessary to prevent economic collapse, but the real effect will be currency debasement on a massive scale. The dollar's purchasing power will continue to erode, and the gap between official inflation statistics and the real cost of living will widen further. So what do you actually do with this information? How do you position yourself to not just survive this crisis, but potentially thrive and build generational wealth like those who understood what was happening in 1932? First and most importantly, understand that holding cash in traditional bonds is likely to be one of the worst positions during this period. Cash will lose purchasing power to inflation, and bonds will suffer as interest rates potentially spike or governments engage in financial repression. Your goal should be to hold real assets that maintain value independent of currency manipulation. Diversification across multiple asset classes and jurisdictions is critical because we don't know exactly how this crisis will unfold or which assets will be targeted. Don't put everything into crypto, even though I think it's one of the most important asymmetric opportunities available. Don't put everything into real estate, even though physical property has historically preserved wealth through currency crises. Don't put everything into stocks, even though equity ownership in productive businesses has been one of the best long-term stores of value. Spread your exposure across different asset types, different geographic regions, and different custody solutions so that you're not completely vulnerable to any single government action or market collapse. Hard assets, including precious metals, real estate, commodities, and productive businesses, should form the core of your wealth preservation strategy. Gold and silver, despite the 1933 confiscation, have preserved purchasing power across centuries and multiple currency crises. Importantly, today, you can hold precious metals in allocated storage facilities outside the United States, making confiscation far more difficult than it was in 1933. Real estate, particularly properties that generate income through rents, provides both inflation protection and cash flow. Focus on properties in areas with strong demographic trends and economic fundamentals, rather than speculating on appreciation in bubble markets. Commodities, including energy, agriculture, and industrial metals, tend to perform well during inflationary periods and currency crises. Productive businesses that own real assets and generate genuine cash flow will survive the transition to a new financial system, though their equity values may fluctuate dramatically during the crisis period. Your cryptocurrency allocation should be viewed as both a hedge against government monetary manipulation and a speculative position on the future financial infrastructure. Consider holding Bitcoin as your core crypto position, given its established network effects and proven resilience. Allocate smaller amounts to Ethereum, given its role as the primary platform for DeFi and smart contracts. And if you have risk capital you can afford to lose, consider carefully researched positions in altcoins that are building real utility and infrastructure rather than pure speculation. Critically, take self-custody of at least a portion of your crypto holdings in hardware wallets or cold storage that you control, because assets held on exchanges are vulnerable to confiscation, bankruptcy, or regulatory freezes. The phrase, "not your keys, not your coins," exists for a reason. Understanding the generational wealth transfer that's coming means recognizing that crisis creates opportunity for those with capital and knowledge. When asset prices crash during the panic phase of this crisis, quality investments will be available at valuations that seem impossible today. Real estate portfolios will be liquidated at fractions of replacement cost. Businesses will be sold for less than the value of their assets. Stocks of solid companies will trade at earnings multiples not seen in decades. Cryptocurrency projects with genuine utility will be available at prices that assume they'll fail, offering 100x potential for the ones that survive and thrive. The people who build fortunes during fourth turning crises are those who preserve capital during the bubble phase, maintain liquidity and purchasing power during the crash phase, and deploy that capital aggressively when assets hit maximum pessimism and distressed pricing. This requires patience, discipline, and the psychological fortitude to buy when everyone around you is panicking and selling. It requires having cash or liquid assets available when opportunities present themselves, which means not being fully invested during the bubble top. It requires doing your research now to identify the quality assets you'll want to own so that you can act quickly when prices reach attractive levels. And it requires understanding that the period of maximum opportunity often coincides with maximum fear and uncertainty when the headlines are most apocalyptic and when your friends and family think you're crazy for investing. Geopolitical tensions are accelerating the timeline for this crisis and adding additional layers of complexity and risk. The competition between the United States and China is intensifying across technology, trade, military, and monetary dimensions. China has been systematically reducing its holdings of U.S. treasuries and accumulating gold, suggesting they're preparing for a world where the dollar is no longer the undisputed global reserve currency. The BRICS nations, representing Brazil, Russia, India, China, and South Africa, plus recently expanded members, are developing alternative payment systems and discussing a commodity-backed currency that would challenge dollar dominance. Any significant geopolitical crisis, whether in Taiwan, the Middle East, or Eastern Europe, could trigger a flight from dollar assets and accelerate the monetary reset that's already developing. The comparison between Federal Reserve actions in 1932 versus today reveals both similarities and critical differences. In 1932, the Federal Reserve actually contracted the money supply during the Depression, making deflation worse and deepening the crisis until Roosevelt took dramatic action to devalue the dollar and expand the monetary base. Today's Federal Reserve has shown repeatedly that it will print unlimited amounts of money to prevent deflation and financial collapse, as we saw in 2008 and again in 2020 when the money supply expanded by over 40% in just 2 years. This means that while the crisis dynamics are similar to the 1930s, the resolution will likely be inflationary rather than deflationary. Instead of prices and asset values collapsing and staying down like they did in the Depression, we're more likely to see a period of volatility followed by massive monetary expansion that drives prices higher in nominal terms while destroying purchasing power. This distinction is critical for your investment strategy because it means you want to own assets that appreciate with inflation rather than holding cash or fixed income securities that get destroyed by currency debasement. It also means that the nominal price of assets like stocks, real estate, and cryptocurrency could ultimately reach levels that seem absurd today, even as their purchasing power relative to real goods and services may not increase as dramatically. Understanding this dynamic is why the wealthy hold assets while the middle class holds savings, and why each inflationary cycle transfers wealth from savers to asset owners. Here's what I need you to understand with absolute clarity as we close out this analysis. The fourth turning crisis we're entering is not theoretical or speculative. It's unfolding right now in real time. The parallels between 2026 and 1932 are not coincidental. They're the predictable result of cyclical patterns that have repeated throughout history. The next 18 to 36 months are likely to bring monetary, economic, and political changes that will seem unthinkable from today's perspective, just as gold confiscation seemed unthinkable to Americans in 1930. The wealth transfer that occurs during this period will be massive, permanent, and life-changing for millions of families. You can choose to be on the right side of this transfer by understanding the patterns and positioning accordingly. Or you can remain in traditional financial structures and watch your purchasing power evaporate like it did for the majority in the 1930s. The time to act is now, before the crisis reaches its acute phase and your options for protecting and repositioning wealth become limited. Study the patterns, understand the assets that preserve value through currency crises, build positions gradually in hard assets and cryptocurrency, maintain some liquidity for opportunities that will emerge, and prepare yourself psychologically for volatility and headlines that will test your conviction. The people who profit from crisis aren't lucky, they're prepared. They understand that crisis is when the old order breaks down and new fortunes are built. They study history, recognize patterns, and act when others are paralyzed by fear or blinded by normalcy bias. If you found this analysis valuable, you need to subscribe to this channel right now because we'll be tracking these developments week by week as they unfold. The mainstream financial media won't tell you this story because they're paid to maintain confidence in the existing system. We're here to give you the unfiltered truth and actionable strategies to protect your wealth. Smash the like button so this reaches more people who need to hear it, and drop a comment below telling me what actions you're taking to prepare for what's coming. Are you buying Bitcoin, accumulating gold, waiting for real estate opportunities? I want to hear your strategy and we can learn from each other in the comments. The fourth turning is here. The parallels to 1932 are undeniable, and 2026 is setting up to be a year that fundamentally reshapes the American economy and global financial system. You've been warned, you've been educated, and now you have a choice about how you'll respond. Will you be part of the wealth transfer from those who don't understand to those who do? Or will you ignore the patterns and hope that somehow this time will be different? History doesn't repeat, but it rhymes. And right now it's rhyming with a period that saw both the greatest wealth destruction and greatest wealth creation in American history. Choose wisely, act deliberately, and I'll see you in the next video where we dive even deeper into specific strategies for navigating the crisis ahead